Something quiet but powerful is moving through the global money system tonight, and many people have not noticed yet. Prices in one market suddenly jumped, and that single move can slowly travel into your job, your bills, and your savings. The number that started this chain reaction is simple but heavy, because oil just pushed above $100 a barrel again. That may sound like a distant market number, but oil is the fuel that quietly runs trucks, ships, planes, and factories everywhere. When oil jumps this fast, the shock does not stay in the energy world for long. It spreads like a ripple through prices, companies, governments, and finally into the daily life of regular workers. Many people first notice it when gas prices climb, but by then, the deeper system has already started shifting. The strange part is that this change did not begin with a headline most people saw. It started in a narrow water path far from American cities and European towns. That place is called the Strait of Hormuz, and nearly 1/5 of the world's oil passes through it. When tension rises around that narrow path, energy traders react almost instantly. Oil buyers rush to secure supply, and prices can jump before most people finish their morning coffee. According to public data, that is exactly what appears to be happening again. Traders are suddenly paying much more for the same barrels of oil. Markets do not wait calmly when energy supply looks uncertain. They move fast, sometimes faster than governments or news channels can explain. And that is why stock markets around the world started shaking almost immediately. It may feel far away, but global markets are tightly connected like wires in one giant machine. One sudden price jump in oil can move billions of dollars within minutes. Behind those billions are real companies, real workers, and real retirement savings. Some powerful people are watching this moment very closely. Billionaire investors like Warren Buffett often study oil prices because they reveal stress inside the global system. When energy rises too quickly, it can squeeze the rest of the economy. A billionaire may see opportunity, but a worker often feels pressure first. The difference between a billionaire and an average family can feel painfully wide. A billionaire may gain another $1 billion during energy spikes. A regular worker may simply see higher fuel costs and shrinking savings. That contrast is one of the quiet realities of global finance. Oil companies are already feeling the other side of this shift. Giants like ExxonMobil and Chevron can earn billions more when oil prices climb quickly. Reports suggest that just a small jump in oil can add several $1 billion to their quarterly profit. Imagine a company gaining $3 to $5 billion simply because the price of energy moved overnight. That number alone is larger than the yearly income of many small cities. But that extra money does not appear from nowhere. It often comes from higher costs spreading across the economy. Airlines are usually among the first companies to feel that pressure. Jet fuel becomes more expensive almost immediately when oil rises. Major airlines like Delta Airlines and American Airlines may suddenly face billions in added fuel costs. That kind of cost can erase profit very quickly. When airlines struggle, ticket prices often follow the same direction. A family planning a vacation may suddenly notice flights becoming more expensive. This is how one energy price slowly reaches into everyday life. Oil exporting countries are also watching carefully. Nations like Saudi Arabia and Russia can gain huge revenue when prices rise. If oil stays above $100, those governments may collect tens of billions more in export income. That money strengthens national budgets and political influence, but countries that import energy face the opposite challenge. Nations like Japan and India may need to spend billions more just to secure fuel. Governments sometimes step in to protect citizens from sudden price spikes. The protection itself can cost taxpayers enormous sums. When governments spend more on energy support, national debt can quietly rise. Debt may seem like a distant issue, but it eventually touches taxes, services, and interest rates. This is why energy shocks matter far beyond gas stations. They slowly push on the entire financial structure of modern economies. Some technology leaders are also watching this shift closely. Billionaires like Elon Musk may see rising oil prices pushing more drivers toward electric cars. If gasoline becomes expensive, electric vehicles suddenly look more attractive to consumers. Even a small shift in that direction could mean hundreds of millions in additional sales for companies like Tesla. That possibility sits quietly behind the energy headlines. Meanwhile, shipping companies face another difficult reality. Nearly everything sold in stores travels by ship, truck, or plane. Higher oil prices raise the cost of moving those goods. Eventually, those costs can appear in the prices people see at the store. Groceries, clothing, electronics, and furniture can all feel the pressure. Some CEOs are already studying the numbers carefully. Leaders like Tim Cook of Apple must think about how rising transport costs affect global supply chains. Shipping thousands of products around the world becomes more expensive when energy rises. Even online giants like Jeff Bezos built their systems around efficient delivery costs. A shift in fuel prices can slowly reshape those business calculations. Markets notice these risks almost instantly. Investors begin adjusting their expectations for profits and growth. Stock futures sometimes fall when energy costs suddenly rise. That reaction is not always panic, but it signals concern. Investors understand that expensive energy can slow economic activity. When costs rise everywhere at once, businesses often become more cautious. Hiring plans may slow quietly behind the scenes. Expansion projects may pause while companies study the new numbers. These small decisions can gradually influence job markets. For workers, that possibility can feel unsettling. A billionaire might move money between investments quickly. A worker usually depends on a steady paycheck and stable prices. That difference shapes how each person experiences economic shocks. Some political voices are already warning about the risks. Leaders like Donald Trump have previously argued that energy shocks can reshape global power. Whether people agree or disagree, energy has always influenced politics and economics. Oil sits at the center of transportation, manufacturing, and national security. When its price moves sharply, the global system listens. Still, this moment is not only about fear. It is also about understanding how connected the modern economy has become. A narrow water route thousands of miles away can influence prices in your neighborhood. That connection is the hidden reality of global markets today. The important question now is not just why oil jumped. The deeper question is what happens next inside the system. Because when energy shifts quickly, other financial pieces often begin moving quietly afterward. And right now, many of those pieces appear to be starting to move. When oil suddenly climbs above $100 a barrel, the story does not stop with energy traders sitting behind computer screens. That number quietly begins traveling across the entire global system like a heavy wave moving through water. One moment it is a price chart in a trading office, and the next moment it starts touching airlines, factories, governments, and families. The deeper truth is that oil is not just a commodity sitting in barrels somewhere in the desert. Oil is the invisible engine that keeps trucks moving, ships sailing, airplanes flying, and factories producing. When the price of that engine rises, suddenly, the cost of almost everything can slowly rise with it. According to market reports, tension around the Middle East is once again making traders nervous about supply. The narrow Strait of Hormuz still carries close to 20% of the world's oil every single day. When even a small threat appears around that route, buyers rush to secure oil before prices climb further. That rush alone can push prices higher within hours. For billionaires and global investors, this moment can look like opportunity. For ordinary workers trying to manage bills and groceries, the same moment can feel like pressure building quietly. The difference between those two experiences can feel painfully real. A billionaire may gain billions from an energy shock. A regular worker may simply see fuel and food becoming more expensive. Some of the biggest winners during oil spikes are energy giants. Massive companies like ExxonMobil control huge oil production and refining operations around the world. When oil prices jump by $10 or $20 per barrel, those companies can earn billions more in profit. Analysts often estimate that a strong oil surge can add $3 to $5 billion to quarterly earnings. Another energy giant, Chevron, benefits in a similar way because its production costs stay mostly the same while selling prices rise. Imagine earning billions more without drilling a single extra well. That is the power of global energy pricing. Meanwhile, oil exporting countries suddenly see money pouring into their national accounts. Nations like Saudi Arabia rely heavily on oil revenue to fund government spending. When oil crosses the $100 level, billions of extra dollars begin flowing into their economy. The same pattern appears in Russia, which exports massive amounts of oil and gas to global markets. Reports suggest that higher prices can add tens of billions of dollars to a country's annual income. That money can strengthen government budgets and increase global influence. But every winner in the energy world usually means someone else is paying more. Countries that import oil must spend far more money just to keep their economies running. Major economies like Japan buy most of their energy from abroad. When prices rise sharply, the government may need to spend billions more to secure fuel supplies. The same pressure appears in India, where millions of vehicles and factories depend on imported oil. Even a small increase in oil price can add billions to the country's yearly energy bill. For governments, this can mean difficult decisions about subsidies, taxes, or borrowing money. Behind those decisions are ordinary people who simply want stable prices for fuel and food. The chain reaction continues into major industries. Airlines are among the first companies to feel the pain of expensive oil. Jet fuel is one of the largest costs for airline companies. Giants like Delta Airlines may suddenly face billions of dollars in additional fuel expenses. Another major airline, American Airlines, could see profits shrink quickly if fuel prices stay high. When airlines struggle with fuel costs, ticket prices often rise soon after. That means a family planning a vacation may suddenly face more expensive flights. The energy shock slowly moves from oil fields into everyday life. Large shipping companies also watch oil markets carefully. Ships carry food, electronics, clothes, and almost every product sold in stores. When shipping fuel becomes more expensive, the cost of transporting goods increases. Eventually, that cost can show up in store prices. This is one reason inflation sometimes rises when oil prices spike. Technology leaders are also paying attention to this moment. Billionaire entrepreneur Elon Musk understands that expensive gasoline can change consumer behavior. When drivers see high fuel prices, electric vehicles begin to look more attractive. That shift could increase sales for companies like Tesla by hundreds of millions of dollars. In a strange way, expensive oil can accelerate the move toward electric transportation. But the transition does not happen overnight. Millions of drivers still depend on gasoline cars every day. And those drivers feel the pain first when fuel prices rise. Another group closely watching this moment is global investors. Legendary investors like Warren Buffett often study energy prices because they reveal deeper economic stress. Rising oil can signal that supply chains are tightening or geopolitical risks are growing. That information helps investors decide where to move billions of dollars. A billionaire can shift money between industries quickly. A worker usually cannot move their paycheck or retirement savings so easily. That difference makes economic shocks feel very unequal. Political leaders also recognize how powerful energy prices can be. Figures like Donald Trump have repeatedly warned that oil shocks can reshape global politics. Energy affects military strategy, trade relationships, and economic stability. And when oil becomes expensive, alliances and negotiations can change quickly. Governments begin calculating how long supply disruptions might last. Some countries even release oil from emergency reserves to stabilize markets. These reserves contain millions of barrels saved for crisis situations. But even large reserves cannot fully replace global production if disruptions continue. That is why markets react so strongly when supply risks appear. Investors worry about a chain reaction spreading through the economy. The pattern often looks like this. Oil prices rise sharply first. Transportation and manufacturing costs begin climbing next. Businesses raise prices to protect their profits. Consumers start paying more for goods and services. Eventually, central banks may raise interest rates to slow inflation. Higher interest rates can make borrowing money more expensive. When borrowing becomes costly, companies sometimes slow hiring and expansion. This entire process can take months to unfold, but the first signal often starts with oil. That is why global markets watch energy prices so closely. At the same time, not every part of the economy reacts the same way. Some companies gain enormous profits, while others face heavy losses. Billionaires might celebrate rising stock prices in energy companies. A delivery driver might simply worry about filling the gas tank tomorrow. The contrast between those experiences tells a deeper story about the modern economy. The system rewards certain industries when energy becomes scarce. It pressures others that depend on cheap fuel to operate. Right now, the world appears to be entering one of those moments again. Before we continue, I'm curious what you think about this shift in energy prices and how it might affect everyday life. Because the next stage of the story may show an even bigger chain reaction moving through global markets. The deeper story of rising oil prices does not stop with companies earning billions or losing billions in profit. The real story begins when that price shock moves into the wider financial system that connects markets, banks, governments, and ordinary families. Many people first notice oil through gasoline prices at the pump, but the system behind that number is far larger than most imagine. 1 barrel of oil influences trucks delivering food, ships carrying electronics, planes transporting travelers, and factories producing goods. When the price of that single barrel jumps, the ripple quietly moves through the entire global economy. That ripple often travels faster than governments can respond. This is why investors around the world watch oil almost like a warning signal for the health of the system. If energy costs keep climbing, companies across many industries must adjust quickly. Manufacturing giants that rely on heavy machinery suddenly face higher operating costs. Large delivery networks transporting millions of packages each day begin paying more for fuel. Companies like Amazon depend on trucks, planes, and warehouses working together every hour. Even a small increase in fuel costs can add billions of dollars to the operating expenses of such massive systems. That is why business leaders like Jeff Bezos built logistics networks carefully designed to keep costs low. When energy becomes expensive, even the most efficient systems feel pressure. Technology companies also feel the ripple in unexpected ways. Devices sold by Apple travel through global supply chains before reaching stores. CEO Tim Cook has often explained that shipping parts and finished products across continents requires complex logistics. When oil prices rise sharply, the cost of moving those products also rises. That can quietly reduce profit margins or push companies to raise prices. Consumers eventually notice when electronics or household items cost more than before. The pressure spreads slowly but steadily through the system. This moment also changes the thinking of global investors managing trillions of dollars. Many large funds move money between industries when energy costs shift. Investors may move toward oil companies and energy producers because those businesses benefit from higher prices. At the same time, they may pull money away from industries that depend heavily on cheap fuel. Airline stocks, transportation companies, and tourism businesses sometimes face selling pressure during energy spikes. That shift can move billions of dollars across stock markets within days. Large indexes that represent the market may also feel the impact. When investors grow concerned about rising costs, stock markets sometimes drop as a warning signal. This does not always mean a crash is coming, but it reflects growing caution. Global markets today are deeply connected through investment funds, pension systems, and retirement savings. When markets shake, the effects can reach ordinary people who never trade stocks themselves. Retirement funds for teachers, construction workers, and office employees are often invested in the same markets. That means market stress can quietly affect long-term savings. Billionaires may experience large swings in their wealth during these moments, but they usually have many investments spread across industries and countries. A regular worker often depends on a single job and a modest retirement account. That difference can make economic uncertainty feel far more personal. Political leaders also understand how powerful oil prices can become. Energy has shaped global alliances and conflicts for decades. Leaders like Joe Biden must balance economic stability with international tensions when oil prices surge. Governments sometimes release emergency oil reserves to calm markets. These reserves hold millions of barrels stored for moments of supply stress. But reserves are only temporary solutions. If supply disruptions continue, prices can remain elevated despite those efforts. Another major factor shaping this moment is the shifting balance of energy production around the world. Countries in the Middle East still control a large portion of global oil supply. Saudi Arabia remains one of the largest producers capable of influencing prices through production decisions. When such countries adjust output by even a small amount, global markets react quickly. Meanwhile, Russia continues exporting large volumes of energy despite geopolitical tensions. Changes in those exports can move billions of dollars in global trade. Import-dependent nations face the opposite challenge. Economies like Germany depend heavily on energy imports to power industry and transportation. When oil becomes expensive, manufacturing costs rise and economic growth can slow. That pressure may influence jobs, wages, and business investment. Countries such as India must carefully manage fuel subsidies to protect citizens from sudden price spikes. Those subsidies can cost governments billions of dollars. To pay for that support, governments sometimes increase borrowing or adjust taxes. Debt levels can quietly climb during long periods of high energy prices. This is one reason economists watch oil markets as a signal of broader financial stress. Expensive energy can feed inflation across many parts of the economy. Inflation simply means prices rising faster than incomes. When inflation rises, central banks often respond by raising interest rates. Higher interest rates make mortgages, credit cards, and business loans more expensive. That can slow spending and investment across the economy. The chain reaction can take months to fully appear. But the first spark often begins with energy prices. This moment also raises questions about the future of transportation and energy technology. Billionaire innovators like Elon Musk believe expensive oil will accelerate the shift toward electric vehicles. If gasoline remains costly, more drivers may consider electric cars over traditional vehicles. That shift could reshape the auto industry over time. Companies investing early in electric technology may gain major advantages. At the same time, oil companies continue generating enormous revenue from global demand. Energy giants like ExxonMobil and Chevron still supply a world that consumes nearly 100 million barrels of oil every day. That demand keeps their businesses powerful even during times of change. For ordinary people, however, the transition between energy systems takes many years. Families still rely on gasoline cars, diesel trucks, and airplanes for daily life. That reality means rising oil prices still matter deeply for household budgets. A billionaire may gain another $1 billion from energy investments. A worker may simply worry about paying for fuel, groceries, and rent. The emotional difference between those two experiences can feel enormous. Yet both exist inside the same global financial system. Markets, companies, and governments are all trying to adapt to the same shifting forces. The challenge is that no one fully controls the system once these chain reactions begin. Oil prices influence inflation. Inflation influences interest rates. Interest rates influence jobs, housing, and business investment. This entire cycle can shape the direction of the global economy. That is why analysts often say energy prices are one of the most powerful signals in finance. When oil moves sharply, the world pays attention. Right now, that signal appears to be flashing again. Some industries are preparing for massive profits. Others are quietly preparing for difficult months ahead. And millions of ordinary people are simply hoping the system remains stable. Because what happens next in the energy market could shape the financial landscape far beyond oil itself. Now the story reaches the most important question that many workers, savers, and families quietly ask when they hear oil prices jumping again. The question is simple but powerful, because people want to know what this moment might mean for the larger financial system around them. Oil alone does not control the world economy, but it often acts like the first domino in a long line of economic reactions. When that first domino moves, the rest of the system sometimes begins shifting in ways that are not immediately visible. The early signals appear inside markets where trillions of dollars move every single day. Traders, investors, and governments watch these signals closely because they can reveal deeper stress building beneath the surface. When oil climbs above $100 per barrel, many analysts begin studying the possibility of rising inflation again. Inflation simply means the price of everyday goods increasing faster than wages. If energy remains expensive, businesses must spend more money transporting goods and running factories. Those businesses often pass some of those costs to consumers. That means groceries, transportation, and household products may slowly become more expensive. Families may not notice the change immediately, but over months, it can quietly affect budgets. Billionaires experience this system very differently from ordinary households. A billionaire investor might gain billions from energy stocks during a period of rising oil prices. For example, investors like Warren Buffett sometimes hold major stakes in energy businesses. When oil companies earn higher profits, those investments can grow significantly. At the same moment, a delivery driver may simply notice that filling a gas tank costs much more than before. That emotional contrast between a billionaire and a worker can feel impossible to ignore. One person's investment gain may equal another person's rising cost of living. Energy shocks have always carried this strange imbalance inside the global system. Governments are also calculating their next steps very carefully. Leaders like Joe Biden must balance economic stability, political pressure, and international relationships during energy disruptions. Sometimes governments release oil from strategic reserves to calm markets temporarily. These reserves contain millions of barrels stored specifically for emergencies, but even the largest reserves cannot permanently replace global supply if disruptions continue. That is why energy markets can remain tense for long periods during geopolitical uncertainty. Oil exporting countries continue watching prices closely as well. Nations like Saudi Arabia gain enormous revenue when prices remain high. Higher prices can add tens of billions of dollars to national budgets within months. Those funds may support government programs, infrastructure projects, or sovereign investment funds managing trillions of dollars. Another major exporter, Russia, also benefits when global oil prices climb. Energy exports remain one of the most powerful financial engines for such economies. But the opposite story appears in countries that depend heavily on imported energy. Economies like Japan must spend billions more purchasing oil from international markets when prices surge. Governments sometimes attempt to shield citizens from sudden price spikes through subsidies or tax adjustments. Those programs can cost national budgets massive amounts of money. If the pressure continues long enough, public debt levels may increase. Debt may seem distant from daily life, but it eventually influences taxes, interest rates, and government spending. The chain reaction continues through financial markets. Investors managing pension funds and retirement accounts often adjust their portfolios when energy costs rise. They may increase investments in oil companies while reducing exposure to industries hurt by high fuel prices. Energy giants like ExxonMobil and Chevron often see stronger profits during these periods. Their earnings can increase by billions simply because the selling price of oil rises faster than production costs. Meanwhile, airlines face the opposite reality. Major carriers such as Delta Airlines and American Airlines must spend far more on jet fuel. That extra cost can erase large portions of their profits. Airlines sometimes respond by raising ticket prices or reducing flight schedules. Travelers may feel that change when planning vacations or business trips. Shipping and logistics companies also face increasing pressure. A large delivery network moving millions of packages daily depends heavily on fuel prices staying manageable. Corporations like Amazon must constantly analyze transportation costs across trucks, cargo planes, and warehouses. Even small fuel increases can add billions to operating expenses across global logistics systems. Technology companies watching consumer behavior may see opportunity in the same moment. Billionaire entrepreneur Elon Musk has long argued that expensive gasoline will accelerate the adoption of electric vehicles. If drivers feel pressure from fuel costs, electric cars may appear more attractive financially. That shift could benefit companies like Tesla significantly over time. Yet the transition away from traditional fuel takes years or even decades. Most vehicles on the road today still rely on gasoline or diesel. That reality means oil prices continue influencing everyday life in powerful ways. Investors are also studying patterns from past economic cycles. Many analysts compare energy spikes to previous periods of economic stress. However, the current system is different from earlier crises. Global debt levels today are far larger than they were many years ago. Governments, corporations, and households collectively owe tens of trillions of dollars. High energy prices combined with rising interest rates can place pressure on that debt system. Borrowing becomes more expensive while living costs increase at the same time. This combination can slow economic growth if it lasts too long. Yet markets rarely move in a straight line. Some sectors expand while others struggle. Energy producers may experience record profits. Renewable energy companies may attract new investment. Meanwhile, transportation industries may adjust operations to manage rising costs. These shifts happen quietly inside boardrooms and government meetings around the world. Ordinary people often notice the results months later through prices, job changes, or economic headlines. That delay can make financial events feel confusing or unpredictable. But the system itself follows a chain of cause and effect. Oil moves first, costs move next. Inflation begins rising slowly afterward. Interest rates and economic policies eventually respond. Understanding that sequence helps people stay calm during uncertain times. No single event controls the future of the economy completely, but moments like this remind us how connected the modern financial system has become. A narrow shipping route thousands of miles away can influence prices in cities across America and Europe. Billionaires, investors, workers, and governments all feel the ripple in different ways. Some gain billions while others adjust to rising costs. The system rewards certain industries and challenges others. That balance is constantly shifting. Right now, the world appears to be entering another period of adjustment. Markets are watching energy prices carefully for the next signal. Governments are studying supply routes and diplomatic options. Investors are repositioning trillions of dollars quietly behind the scenes. And ordinary people are simply hoping that stability returns before the ripple grows larger. Because when energy prices move this sharply, the story rarely ends with oil alone. It often becomes a larger chapter in the ongoing story of the global economy. If you enjoyed this deep dive into how oil prices shape the global economy, make sure to like the video and subscribe to Market Mindset for more stories about money, markets, and the forces shaping our financial future. And if you think more people should understand how the global economy really works, share this video with someone who would find it interesting.